I didn't think that the Fed would have the ability to tighten as fast as they did. My suspicion is that the pain will continue to be felt on a more delayed basis.
In today's video, Rick Rule, founder and CEO of Rule Investment Media, talks about the Fed's aggressive rate hike strategy will lead to even more inflationary pressure, weighing heavily on consumers in the long term. Rule advises against trying to forecast markets with as many variables as there are saying, it's trying to know the unknowable. Investors should instead focus on fortifying their portfolios, he concludes. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
I'm frankly delighted that the economy has held together as well as it has in the face of higher interest rates. I didn't think that the Fed would have the ability to tighten as fast as they did. My suspicion is that the pain will continue to be felt on a more delayed basis. I think the halting sales of things like consumer durables, but more importantly, single-family residential, and certainly the malaise that you're seeing in equity markets, means that there's more pain to come. But I'm frankly delighted that they've been able to get away with as many raises as they have, if only so that they, from their point of view, have some powder dry, the ability to loosen if they think they need to.
But how could things have been worse? I mean, we have the S&P that's basically melting. Like, what areas were you more concerned for?
Daniela, I lived through the decade of the 1970s. I lived through a period where the prime interest rate exceeded 15%, where the first mortgage rate exceeded 17%. And believe me, it can get worse than this. The pain coming out of the inflation of the 1970s, the Volcker-induced pain, while it was necessary, was severe. The misery index, as they called it in those days, which was the sum of the U.S. 10-year Treasury rate and the rate of inflation and unemployment, was spectacular. So as painful as this has been for some, it is only a down payment on the pain that we might have expected had they totally lost control. I realize that's a small measure of relief for people who are suffering pain this time.
Yeah.
You could stabilize inflation other ways. You could have less government control. You could have less government expenditure. An awful lot of the inflation that we're experiencing was in fact caused by government. The way that the government created liquidity for an economy that they were crowding out by public borrowing was, in fact, artificially low interest rates. I don't believe that the current political situation in the United States would allow the Fed to reduce inflation by the way that Mr. Forbes suggests. I wish it were the case, but the truth is, if you were, I suspect, to poll Republicans and then poll Democrats as to whether they would see their favorite government programs, if they'd be willing to see their favorite government programs defunded in order to put the economy on a better footing, most would say no. So while what Mr. Forbes says is possible in the theoretical world, I think it's improbable in a world where voters continue to attempt to award themselves favors. You must either have fiscal controls or monetary controls. And I suspect, like Warren Buffett says, the time spent trying to forecast markets with as many variables as there are is trying to know the unknowable. I think that what your listeners would be better advised doing is to get their own house in order fiscally. The idea that we're going to get the American house in order fiscally seems to be a non-starter. So my suspicion is that investors must acknowledge that acknowledge the fact that the political class doesn't have their interests at hand, and organize their own lives in a way that they can defend themselves as well as possible, given the circumstance that faces us. That while cash imposes immediate pain, in the sense that the deposit interest rates that you get paid guarantee you a loss after inflation, you have to have cash anyway, because in a period of declining liquidity, particularly if we have a replay of 2008, the cash will give you the tools and perhaps the courage to take advantage of a situation rather than being taken advantage of. It is true that you are, after inflation, losing 4 or 5% of your purchasing power holding cash. But I have two observations. That negative interest rate that you suffer is really an option premium to allow you the liquidity to take advantage of the illiquidity of others. And as we have seen in 2022, losing 5% beats the hell out of losing 20% in other asset classes. So I continue to say that investors, despite the pain, must continue to be liquid. For me personally, Daniela, not for many of your listeners, but for me personally, that liquidity includes gold. I include it because I am willing to sell my gold, use it as liquidity, if a different asset class becomes more attractive to me. Many investors, if they bought gold at 1,800, are unwilling to sell it at 1,650, even if there is a more suitable opportunity on the horizon, because they don't want to quote, take a loss. For me personally, liquidity comes in many forms, principally U.S. dollar liquidity, but also liquidity by way of bullion. But this doesn't feel dramatic to me. People are angry, people are hurt, people are confused. People are not terrified. I remember 2008 very, very, very well. I remember that members of the public, not just the chattering classes, were concerned about the total breakdown of financial markets in the United States. People were worried about bail-ins. They were worried about their savings being confiscated by the Fed to salvage the banking system. I don't see that level of fear yet. In 2008, we watched major markets go no bid. Right now, we're just seeing markets go lower. I'm not trying to say that we are going into a period of full-blown panic. What I am trying to say is that investors need to be defensive, both with regards to their portfolios, but probably particularly with regards to their psyches. You are going to continue to experience lots of volatility. And if you have a strong psychological framework in your investments, you are more often than not able to take advantage of volatility as opposed to being taken advantage of by markets.
Is the U.S. dollar strength merited? Is it real?
I think ironically it is, not so much because of the strength of the U.S. political system and the economy, but because of the relative weakness of others. I forget whose quote it was, perhaps Doug Casey's, but someone described the U.S. dollar as, quote, the prettiest mare at the slaughterhouse. The circumstance around the U.S. dollar in the intermediate term and the long term is not pretty. However, the crisis in other currencies, particularly, of course, the euro, with the political instability in the southern cone of Europe, but also in Great Britain as a consequence of some of the political decisions made there over the last 10 years, means that they are facing their reckoning before we are. And the instability there, and particularly the very, very low real and nominal interest rates there, mean that European savers have a real incentive to dump euros, dump pounds, and buy dollars. And that's precisely what you're seeing. I think you are seeing a circumstance around the world where ordinary people are sick of being ordered around by the big thinkers. They have been told for 15 years that there needs to be an expansion of social services. People only like social services when they get them. They don't like social services when they come out of their pocket and benefit others. They have been told that their energy future is expensive and intermittent. And they watch, Italian people watch, while 550 of the big thinkers take private jets to Davos and then tell Italian people that they should drive less. The big thinkers seem to believe that ordinary people are stupid. Ordinary people were stupid to listen to the big thinkers for as long as they have. My own belief is that the more xenophobic forms of nationalism, some of the forms that I think you're going to see in Italy, that you're seeing in Hungary, that you're seeing in Poland, and by the way, that you saw in the Ukraine, are counterproductive. I think a world that is less regulated, a world that is more diverse, and I'm not trying to be woke, a world where the free movement of goods and services is encouraged, is a richer world. But a world where that freedom is manipulated to the advantage of the political class is a world that gives us what we're experiencing today. Europe is going to have some real challenges.
Yeah.
From a fiscal point of view, if you look at the combined debts of countries in the European Union relative to the economic surplus that Europe generates, they're in worse shape than the United States is, and the United States is in bad shape indeed. In addition to that, the Europeans have been sold on politically correct energy, which is to say, in Germany, as an example, relying on solar, where the sun doesn't shine. The consequence of that and the conflict in the Ukraine means that this is going to be potentially a very challenging period for Europe. Challenging perhaps for the Southern Cone in particular, because the Southern Cone has relied on subsidies from Northern Europe. Northern Europe perhaps can't afford those subsidies anymore. One of the things that the Italians are angry about is they're being asked to pay their own bills. Something that always bothers voters.
You know, I know a lot of investors are frustrated by the price of action of gold. If I could share my opinion, I just see it, as you say, it's on sale right now, if you want to look at it that way. And it's done, relative to the S&P and other assets quite well, given the context of things. But my opinion doesn't matter. Yours does. So what's your take on gold?
Well, first of all, it's a personal opinion. I sleep better owning gold. And at 69, sleep is an important thing. I hope, Daniela, I'm wrong about gold. Gold does well during times when people are concerned about the stability of their purchasing power in ordinary currencies in a normal economy. And I hope I'm wrong. I hope I'm wrong to be concerned. However, I need to say, personally, I'm suited by lower gold prices in the near term. If gold were to advance from 1,650 or whatever it is an ounce to 22 or 2,300, I wouldn't sell. It would evoke no action from me. If gold were to fall from $1,650 to $1,500, I would buy lots. So, ironically, although I have reasonable gold holdings, it is in my interest, given the way I would like to organize my own affairs, to see the gold price lower rather than higher. Now, that will evoke a lot of hate in the comments section at Stansbury Research when this interview is published. People will say he's old and fat and rich. All of that is true. I suspect that if other people adopted the time frames that would allow them to become rich, that they would become rich too. Higher gold price reflects very poorly on the central banks. I just don't see them capable of doing it. My opinion of central bankers is, had they not come from good families and gone to good schools, that they'd probably be bagging groceries at 7-Eleven. The idea that these big thinkers who lost the war on poverty, lost the war in Vietnam, lost the war on drugs, the idea that there's enough competence among all the world's central bankers for 40 years to depress the price of gold, seems to me to ignore their lack of capability. Control what you can control. The biggest risk for you, for your viewers, is conveniently located to the left of their right ear and to the right of their left ear. Exercise common sense. Buy high-quality companies that generate lots of free cash and have decent balance sheets. Own whatever type of liquidity appeals to you. Live within your means. Buy a piece of real estate, not because real estate always rises. Buy a piece of real estate because you expect the rents to rise and you expect your return on capital employed to increase while your cost of capital decreases. If it doesn't, don't buy it. This is all simple stuff. In terms of what I do for a living, natural resources and to a lesser extent conventional financial services, these are businesses that over the next few years should do very well. We have underinvested in exploration. We've underinvested in pipeline. We've underinvested in construction and development, and we've done it for 30 years.
That's right.
We are coming into a supply cliff. That supply cliff may very well be delayed by a recession or a depression. Delayed is not the same as obviated. So pay attention to the fact that we're coming up on a supply cliff in natural resources. So include natural resources in a portfolio. Investing is largely about discipline and common sense. And any of your listeners whose fear causes them to go into a cocoon, which is to say to do nothing, not to take control of their financial future, will certainly lose. But don't be afraid of the economy because of Biden or because of Trump. Be afraid of the economy because you haven't done the work yourself to take advantage of the situation rather than being taken advantage of.